Good afternoon. This is Brian Split with Allendale here for your closing commentary on Friday, November 12th, 2010. As I'm sure probably most of you know by now, we were sharply lower not only in the grains but across the commodity market. We had a lot of broad-based selling today with talk of continued debt concerns in Ireland and also concerns that China is going to make moves to continue to try and curb their domestic inflation by raising interest rates. So as far as where we settled today, the December corn contract was down the 30-cent limit at 5.34. That is down 53 3/4 cents on the week after making a new high to 6.05 off of the report on Tuesday. The December 11 contract down also the 30-cent limit at 5.09 1/4. That's down 46 cents in a week, and again after making new highs to 5.65 3/4 off of the report. On the soybean side, we were down the 70-cent limit in January at 12.69. That's down only 15 cents on the week. The November 11 contract also down the 70-cent limit at 11.77, down 45 cents on the week. One thing of note on the soybean chart today is that the overnight trade did open above yesterday's highs and closed below yesterday's lows. So a very very definitive key reversal on that January soybean chart, and that is a very strong sell signal there. On the wheat, we did have December nearby Chicago down 34 3/4 at 6.69 1/4. That's down 59.5 cents on the week. July 11 new crop down 38.5 today at 7.44 3/4. That's down 57 3/4 on the week. So again, this was not just in the grains. As far as the selling that we saw today, the funds were actively selling. We had 30,000 contracts of corn sold by funds, 14,000 soybean contracts, 9,000 wheat contracts, 4,000 soy meal contracts, and 6,000 soy oil. So again, very active selling by the funds, but we saw a lot of selling in the other markets as well. So moving to the meats here, we had a lot of ferocious spreading today, both in the hog and the cattle markets. The December hogs only down 15. August 11 down $2.30, and there's been a lot of buying in these deferred contracts with the prices of grain going up, limiting ideas of possible expansion, and with the prices coming down as much, those back ends really took a hit today. Same thing in the cattle. We had December down 65, the August down $1.85, so again seeing some pressure there. The feeders were lower today. You had Jan down 67, August down 40. But again, with the price of corn coming down, they were supported compared to the other markets. As far as the stock market, we are seeing the same story there. The Dow Jones futures down about 85 points, S&P down 14, and the NASDAQ down 34 as we go into about the last half hour of trade. As far as the dollar, we were actually trading higher, but last trade down about 15 points. Gold settled to $38 lower roughly. Silver down $1.46. Copper down 12.5. A lot of profit taking in the metals today, again based off of the Chinese concerns. Some of these soft markets again getting nailed. You had sugar down 345 points. That market over the past two sessions has been down over 600 points, which is just a monster move there. And news came out yesterday that India went from having a deficit to a large surplus, finding a lot of sugar somewhere. So good for the Indians out there. Great. Cotton down the 5-cent limit today, and that was in the May and July. The December did not finish down limit, but we had guys looking at this new crop December 11 cotton contract at $1 a pound before the stuff's even in the ground, and we're already 10 cents off of that level based on today's close. So that's got to have you cotton producers really looking at where you want to start getting your hedges implemented here. But the bottom line, we've seen the Federal Reserve come out with some quantitative easing that initially had the investors looking like we needed to continue to sell the dollar and buy commodities. This potential rate hike by China is really anti-inflation, and it's going to limit the effects of the Fed's actions here. So the commodities are going to continue to be very highly correlated to any other policy decisions that we receive, regarding inflation. So we're going to want to keep an eye on this. Last time China did raise interest rates was October 19th. We had sharply lower trade off of that, but the next day it was deemed as overdone and we were sharply higher, and a lot of markets eventually went on to make new highs. So that is something to keep in mind, but this activity does feel a little bit different, and we've got some bad chart signals to go along with this type of trade. And don't normally do this, but I'm going to show you a chart here on paper, and this is something that I had noticed on the way up. And what I'm going to show you is the first chart here is this continuous corn chart. So you can see that what I did is draw a trend line from where the market gapped on the way up, and it hit the point at where the market gapped lower on the way down. Interestingly enough, if you scroll over here to recent trade, we gapped higher over the same trend line. So maybe reason would say that if we gapped lower through that same line, that potentially the market has put in its top again. So let's fast forward to today's chart, the same chart but including this week's bar. As you can see, the low on this bar went right to that same trend line, suggesting that if we do gap lower on Sunday night's trade, assuming that this rationale is correct, that this market could have potentially put in a short-term top. So that's just something I wanted to show you guys, a little graphical representation of what I'm personally looking at on this corn chart right now. But you guys probably have a lot of questions about what to do, where do we hedge. Allendale has put out hedge recommendations that we are in currently. We've got December 11 corn hedged right now at 552.5 on 20% of our anticipated production. We also have the November 11 soybeans hedged at I believe an average of about 1219.5 on a total of 40% of our anticipated production. So these are levels that are currently well above current futures trade, and again, whether or not you want to use futures to hedge your production, the main message that Allendale is putting out is to start getting active on looking at protecting next year's production at these levels. So call your broker. Let's get some strategies in place. What we don't want to have happen is getting caught flat-footed and getting just caught in the sense that these markets are going to keep going up forever, because they don't. And a lot of times these markets tops on things that have nothing to do with the fundamentals of grains themselves. So let's not forget that we're at high prices. We do have a lot of downside risk ahead of us if there is further liquidation, and that's a lot of money that's in your pocket right now that won't be if this market keeps going down. So give us a call, 1-800-262-7538. That's 1-800-2-MARKET. Take a look at our commentary online at www.allendale-inc.com. And again, we advise you to get your seats booked here for our conference. It's going to be January 21st and 22nd of 2011. So want to keep you guys in charge of your marketing plans instead of being at the mercy of these markets. Again, this is Brian Split with your closing commentary, and have a great week trading. Thank you.